Friends, welcome to the channel JAIIB and CAIIB Made Simple. This is our unit number 34 theory portion of IE&IFS. Chapter name is Interconnectedness of Market and Market Dynamics. So first of all, let's see what are the topic which we have to study. So first of all, we will see the objective of it. Then after we will see the introduction. What is the process of integration of the process of interconnectedness of the financial market? What is the reason for this interconnectedness? What is the importance of interconnectedness in the context of interconnectedness of financial market, heterogeneity of the financial market, achievement of the market integration in India, different level of market integration, Asian Clearing Union, benefit and cost of interconnectedness of market. So basically there are 15 topics. We will try to cover all this topic in 2 sessions, right? So 34.0 to 34.6 will be covered in the first session and the rest part in the second session. So let's get started with the first point, that is the process of interconnectedness in the financial market. Let's understand each and every aspect of it. So financial market are like the heart of any economy. These include market where people deal with money, stock and bond, foreign currency, loan, insurance and pension. All these parts work together to support economic activity. So several things drive this market to connect with each other more and more. So I told you, these are the components of it: money, securities, forex, credit, derivative, insurance, pension fund, right? And I told you about the integration driver, right? Several things drive this market to connect with each other more and more. As countries develop, as countries trade globally, ease rule and use better technology, their financial market become linked, right? So you can see this word: globalization, deregulation, advances in information technology. Basically all these factors drive the integration of the domestic and international market. So this connection means what happened in one market can affect other market around the world. Now if you look at the global resonance, so as you can see, for example, the 1997 Southeast Asian financial crisis. 1997 Southeast Asian financial crisis, it started in Thailand. Where it started? It started in Thailand, right? But it quickly affected many countries in Asia. Although this 1997 South Asian crisis started in Thailand, but it affected many countries. Similarly, the global financial crisis in the year 2008-2009, it mainly began in US, but in the US housing market, but it is spread globally. This shows how market are coupled, how market are linked. So trouble can spread like a contagion, affecting many other. When market are integrated, what happened? Similar investment tends to offer similar risk. This is called contagion effect. Very, very important point I'm telling you. Basically when market are integrated, what happened? Similar investment tend to offer similar risk and return no matter where they are. So when market are integrated, similar investment tends to offer similar risk and return no matter where they are. This gives investor easier access to different market worldwide, making trading smoother and more unified. In short, we can say financial market are not isolated. Today, they are closely connected both within the country and across border, meaning event in one place often ripple through other. There is ripple effect. So friends, one example I have given you, 1997 Southeast Asian crisis, where the devaluation of the Thailand currency caused market trouble across many Asian countries. And second example I told you, the 2008 global crisis is starting with US mortgage problem, and it is spread to banks in Europe and beyond. So let's recapitulate the key point which we have covered in this particular slide. What we have discussed, financial market involve money, security, forex, credit, insurance and pension. Second point I told you, economic growth, deglobalization, deregulation and technology drive market integration. And one more point I told you, problem in one market can quickly affect another worldwide. This is called contagion effort. Then we discussed integrated market aims for similar risk return on investment everywhere. Easy access across market segment help unify global financial market. And today's market are highly interconnected within country and also internationally. Now friends, let's move forward and let's see the reason for this interconnectedness. So friends, let's discuss that why financial market are connected and why does it matter. So reason for financial market interconnectedness. Financial market around the world, they are connected for several important reasons. The first reason is the capital mobility. It means, moving more capital moving across border. Yes, it means more capital moving, right? More capital moving across the border. Countries today often need more money than they earn inside. So they borrow or they receive investment from other country. This make money flow easy from one country to the another. That is called capital mobility. Second point is technological advancement, means better technology. Thanks to new technology like electronic payment, fast communication, moving money across countries quicker and easier than before. So thanks to this electronic payment, communication, right, it minimizes the arbitrage opportunity and it facilitates. So basically, because of this new technology like electronic payment, faster communication, moving money across countries quicker and easier. This also reduces chances for people to make quick profit unfairly from price difference. What is arbitrage? Basically, arbitrage means, making quick profit from what? From price difference in different market, different prices are there, and because of these different prices, there's an opportunity of making profit, and this is what we call arbitrage. So it minimizes arbitrage opportunity. What minimizes arbitrage from opportunity? Electronic payment and communication. Next point is, monetary policy evolution, or we call it similar rules and regulation. And one more thing is regulatory harmonization, which means similar rules and regulation. So first of all, let's talk about this monetary policy evolution. So central bank used to control money by setting a strict rule on amount, but now they mostly use interest rate to guide the economy. See, earlier what used to happen, that the central bank like RBI, right, so they used to control money by setting a strict rule on amount. Yes, they used to set a strict rule on a what is they used to set a strict rule on amount. But now what happened, but now there is a shift. Now they mostly use interest rate to guide the economy. So basically this change help align interest rate across different country and connect their financial market deeper. Then we have similar rules and regulation. So countries are adopting common international standard for financial safety, for financial regulation. That is called adoption of international best practices in prudential regulation. This means bank and companies face similar rule, making it easier to trade and compete fairly across border. Now one question is, why interconnectedness of financial market is so much important? Let's answer it question. Because having interconnected financial market is very helpful for many reasons. The first reason is it stop market imbalance, and it stop unfair profit. That is called prevent arbitrage and market imperfection. So when market are connected, there is less room for people to exploit price difference unfairly. Yes, very important point. When market are connected, right? When market are connected, what happens? That there is a less room for what? For people to exploit price difference unfairly. That means there is a less room to take advantage of the arbitrage. What is arbitrage basically? Arbitrage is nothing but exploiting the price difference unfairly. So less room is there. This help make market more efficient and more fair. So fostering more perfect and more efficient market. Second point is transmit price signal. That is called spread information important price information. So basically when markets are connected, they help government, they help policymaker share important signal like interest rate, like inflation data across different market parts. So that is called spreading important price information or transmitting price signal. So when markets are connected, there is less room for people to exploit price difference. Third point is spread in okay. So one more thing is spread important price information we have just discussed. Then promote economic growth, as you can see. So basically when financial market work well together, people save, people invest more easily. This help business grow and the economy develop faster. Next point is global financial hub. So basically what is the meaning of global financial hub? It means making a country a financial hub. Integration helps a country become a key player in the world of finance, acting as a center where money flow and big financial decisions happen. That is called, global financial hub. So makes a country a financial hub. Integration helps a country become a key player in the world of finance. Then boost competition and stability, as you can see clearly written here. So basically what happened, so more competition among bank and financial firm leads to a smarter use of money and more stable system that are less likely to crash. That is called, enhancing competition. So if suppose more competition is there among bank, what will happen? This will lead to a smarter use of the money. Yes, since competition is high, money use will be a smarter, and since money use will is smarter, right? What happen? More stable system that are less likely to crash. Then we have, it drive innovation, it drive accessibility, which means, connected market inspire new financial product, new financial services, and make it cheaper. Let me give you some example. Thanks to the better technology and common rules, investors from Europe can easily invest in the US stock market and vice versa. Second example, when US Federal Reserve changes interest rate, this signal quickly affect borrowing cost in many countries, showing financial links. And country like Singapore, right, they have become global financial hub because they are well connected with worldwide market. So let's recapitulate the key point which we have covered in this particular slide. We discussed that capital flow easily between countries as they depend on each other financially. Second point, technology, electronic payment, it made cross-border money movement faster and cheaper. Third point, central bank now use interest rate to guide market, helping align global finance. Fourth point, common international rule make trading and competition fair and smooth. Fifth point, connected market reduce unfair profit and improve market fairness. Sixth point, integrated market help policymaker share useful price signal. Seventh point, financial integration boosts saving, investment and economic growth. Being connected helps a country become a major global financial center. More competition leads to better and safer use of resource. Innovation, access to financial product increases. Connected market encourage responsible behavior and transparency. And finally, advanced technology adoption support efficient financial service. Now friends, let's talk about the heterogeneity of the financial market. So friends, basically financial market are not all the same. They come in different types and works in different way to serve various needs. First of all, let's talk about the difference between national and international segment. Some market mostly operate inside one country. For example, money market, credit market usually focus on local borrower and lender. So this money market and credit market, they focus on local borrower and lender. But other market like forex market, cross listed stock market, right? So they basically, these are the market where company list their share in more than one country. Company list share in more than one country, right? So it work across border internationally. So some markets work within the nation, some market works internationally. That is the point. Second point is, so basically what we are discussing the diversity of the financial market. So second point is depth and liquidity difference, which means, market also differ in how easy is it to buy or sell asset quickly without changing the price. So we are not changing the price, but how easily we can buy or sell asset quickly. So money market where short-term loan or fund are traded, they tends to be more liquid. They allow quick buying, they allow quick selling. Capital market, like for a stock and long-term bond, it can be less liquid because the assets are harder to trade instantly. So that is called depth and liquidity. Next point is economic nature of instrument. So basically different types of instrument we have. So financial market often offer many kinds of instrument, each serving different need. Some help people save money, other provide way to invest, borrow money or manage risk through option and derivatives. Next point we have is the risk profile. So risk level vary. Not all financial products carry the same risk. For example, government bond. So take the case of government bond. The government bond, they are considered safer. Right? And they have lower risk. The government bond have lower risk and they are considered safer. Corporate bond issued by company, they carry higher risk but often offer better return. So this balance between risk and potential reward is called the risk return trade-off, as you can see clearly written here. And then we have the diverse participants, which means many different groups take part in financial market. This include bank, mutual fund, insurance company, pension fund and other specialized financial institutions. So let me give you some example to make this more clear. For example, the US money market help business quickly borrow cash for short period. While the New York Stock Exchange is a capital market where company raise long-term investment fund. When you buy a US Treasury bond, you are choosing a low-risk investment backed by the government. But if you are buying corporate bond from a startup, it carries more risk and potentially more reward. And the third example is mutual fund pools money from many individual investors to buy stock and bonds, while insurance company offer protection against risk like accident or illness. So let me summarize what we have covered in this particular slide. I told you that some market operate only within one country, other work internationally. Then we talked about money markets are generally more liquid than the capital market. Third point, financial instruments serve different purpose like saving, investing, borrowing and risk management. Fourth point, risk vary. Government bonds tend to be safer as compared to the corporate bond. And finally, various participants like banks, fund, insurance company, they take part in this market. India has been working hard to connect different financial market better. The goal is to make the whole system work more smoothly and more efficiently. First of all, let's see the objective of the reform. What is the purpose of this reform? The main aim is to bring together different part of the financial market, like a stock, like bond, and the money market, so that they function as a one. So basically, this helps to reduce the chances for unfair profit from price difference. Again and again, I'm repeating. It reduces the arbitrage, right, and make the system more efficient. The second point is, efficient fund allocation. That means efficient use of the fund. By linking market well, money can be priced more fairly and flow to where it is most needed. This means business and people get fund at the right cost, helping the economy grow. The next is domestic integration effort. So that means effort within India. The government and the regulator have focused on creating healthy competition among financial institutions, introducing new financial products, simplifying rule across money movement, lowering transaction cost, and increasing the ease of buying and selling in the market. That is what we call liquidity. So this is what we call domestic integration effort, which means effort within India. Then we have linking with the global market, or we call it global integration. So that India is carefully opening up its financial market to the world, making it easier for foreign investor and Indian company to interact with the global financial system. This is done gradually and in a planned way to keep the economy stable. So they promote competition, deepen market with innovative instrument, rationalize capital and exchange control. So this is regarding the domestic integration effort. Then we have policy importance, that is called policy focus. So a strong policy are in place to make sure that changes in central bank rate or other monetary policy quickly affect the economy. So a solid and well-connected financial sector is the goal. So let me give you some example of it. For example, using technology and better regulation, stock exchanges in India are more connected with bond and money market. So investor can move fund easily. Second example, India allow foreign investor to buy Indian stock and bond under controlled rule, linking Indian market with the global financial world. Third example, when the Reserve Bank of India changes interest rate, those changes now flow faster to the bank and the market, influencing lending and borrowing. So these are the topic points. So what we have covered in this particular slide, let's recapitulate. I told you India aimed to connect different financial market to work as one system. Better market link help money flow efficiently and reduce unfair profit chance. Third point, reform encourage competition, new product, simple rule, lower cost, high market activity inside India. Fourth point, India is gradually opening up to global market in a careful way. Fifth point, a stronger policy help market change impact the economy quickly, creating a stable and well-connected financial sector. Now friends, let's talk about the level of market integration. So financial market can be connected at different level within a country, across region and globally. So first of all, let's talk about the domestic integration. So different part of the financial market inside a country connect with each other. For example, take the case of a stock market. So a stock market, bond market, loan market, they work together smoothly. This helps saver, investor, bank spread their money around safely. A bit like not putting all your egg in one basket. The second point is interest rate in these market tends to align with the main reference rate, which help keep things liquid and shows how the country's central bank policies are affecting the economy. That is the point. Again, I'm repeating, interest rate in this market, they tend to align with the main reference rate. So this help keep things liquid and shows how the country's central bank policy are affecting the economy. Often what happen, the same financial institution like bank, they work in many areas. For example, they take deposit and also give loan. So for example, in India, bank takes saving from people as deposit and also provide loan to businesses, connecting the deposit market with the loan market. Then we have the global integration. So basically that is across the country. So this level allow money and financial service to move freely across border by removing hurdles like capital control. It goes deeper when people, technology, financial market player start moving and working across country, making market more connected internationally. Harmonizing or mutually accepting different countries' rule and standards help the global integration happen smoothly. So let me give you one example to make it more clear. So investor from the US can buy a share listed in Indian stock market and vice versa because many countries recognize each other financial regulations. Then we have regional integration, which means this happens when countries in a particular region connect their market, often centered around a big financial hub in that region. So regional integration is often easier to achieve because countries are close by and have strong economic ties. Network effects and proximity help a lot. Now economists, let's talk in the context of economics. So there is a model that is called gravity model. So economists use this gravity model to explain how money flow between countries based mainly on how big their economies are and how close they are to each other. So gravity model explains that how money flow between, so money is flowing between the countries, right? That is called the regional flow. So how this regional flow depends on how big their economies are and how close their economy are to each other. So that is called the gravity model. So this encourages development of local market through a strong institution and adopting the best management and operational practice. Now India take part in the regional initiative like the ACU, Asian Clearing Union, which help country in Asia clear payment and settle transaction with each other more efficiently. Let me give you one example. Take the case of ACU, Asian Clearing Union. They make it easier for country like India, for country like Bangladesh, right, and Sri Lanka to settle payment without using foreign currency for every transaction. So let's recapitulate the key point which we have covered now. So I told domestic integration. I told you domestic integration link financial segment inside a country. They help diversify risk and align interest rate with the central bank policy. Second point I told you, global integration. So global integration remove barrier to free capital flow, allow cross-border movement of people and technology, and require harmonizing rules between countries. Then we talk about regional integration. So they connect nearby country financial market across regional center, encouraged by proximity and economic size. India's participation in regional financial cooperation like Asian Clearing Union, helping smoothing the regional transaction. Now friends, let's cover in more detail regarding the ACU, that is called Asian Clearing Union, what it is all about. So Asian Clearing Union, is a special system where some country in Asia work together to make paying each other easier and cheaper. So basically it is a kind of arrangement among some kinds of bank, some countries in Asia, basically they work together. What is ACU? So basically it is an arrangement between the central bank of member country. So ACU have some member country and all the member country have their central bank and their central bank, there is an arrangement between the central bank of this country to settle the payment, right? So they settle the intra-regional transaction. To settle the payment, right, they owe each other in a simplified way. That is called settling on a net basis. That is called settling on a net basis. So instead of each country paying every time there is a transaction, they add up what they owe and what are owed, and only the difference is paid. This helps save time and this helps save money. That is called the net basis. They are not paying every time there is a transaction. Rather, what they are doing, they are just adding up what they owe and what are owed, and finally the difference is paid. That is the peculiarities of this ACU. Then we talk about the main goal of ACU. First of all, to make payment for trade and other eligible transaction between member country easier and faster. This is the first objective. Second objective is to save foreign currency reserve by reducing the number and cost of the money transfer abroad. You can see, conserve foreign exchange reserve and reduce transfer cost. Third point, to help grow trade and build a stronger banking ties within the region. So question is, why was this ACU created? Let's look at the background of it. So friends, after the gold standard system broke down and international money market become unstable. So two things I am telling you. First of all, of the gold standards broke down and the collapse of the international capital market. Because of these two reasons, many Asian countries faced a shortage of the foreign currency and they had problem to settling payment within each other. To solve this problem, ACU was started in December 1974, right? Under the United Nations ESCAPE. What is ESCAPE? ESCAPE, is Economic and Social Commission for Asia and Pacific. So how does it work? So let's look at the mechanism of it. So instead of paying each country in full amount right away, rather member country central bank regularly calculate the total money owed in and out. They then net off the amount, meaning they cancel out what is out and what is due, and only the balance is settled. Importantly, payment can be made in each country's own currency, helping reduce pressure on foreign exchange reserve. That is one important point, that you can use the national currency and elevating the foreign exchange constraint. So that is the meaning of periodically offsetting debit and credit. I hope it is clear. So instead of paying each country in full amount right away, member country's central bank regularly calculate the total money owed in and out. They then net off that amount, meaning they cancel out what is owed and what is due, and only the balance is settled. Now the question is, who are the member? Yes. So who are the member? ACU include Bangladesh, Bhutan, India, Iran, Maldives, Myanmar, Nepal, Pakistan and Sri Lanka. So these are the 9 countries working together for a smoother payment. What are the key benefits of it? So yes, if we talk about the benefit of ACU, you can see that it speed up the trade between these countries by saving foreign currency until the final settlement. Second point is, they help these countries start opening up their trade with each other, making it easier to buy and sell goods and services. Third point, enable country to grow trade and take advantage of cost saving from larger market. Fourth point, as you can see, it support country in adjusting their economy to becoming more competitive internationally. Fifth point, encourage balanced trade country among members. And sixth point, create a foundation for broader cooperation in economics, money and finance within the region. For example, imagine India export goods to Sri Lanka. So this is India and it is exporting goods to Sri Lanka. Right, to Sri Lanka, and Sri Lanka export goods back to India. Okay, so instead of both countries sending full payment separately, they add up how much they owe each other. So suppose if India owes Sri Lanka 10 million and Sri Lanka owe India 8 million. So only 2 million difference is there, is actually exchange. So this save both country money and help them use their foreign currency more efficiently. So let's recapitulate what we have covered so far. I told you ACU is a payment system among 9 Asian countries. How many Asian countries are there? 9 Asian countries are there, right? It settles transaction by netting of payment, reducing the need for full individual transfer. Payment can be done in national currency. It saves foreign exchange reserve. ACU was created in December 1974 to solve foreign exchange and payment problems. So friends, the topic is benefit and cost of the market connectedness. So financial market around the world are becoming more connected. This has brought many advantages but also some challenges. Let's look at both the sides. First of all, the benefits. So better use of capital. Already I told you that when money can flow freely between countries, it finds the best place to grow. For example, if India has a promising business idea but not enough funding, investors from the US or Europe can invest in it, boosting the growth. So that is called efficient allocation of resource across border, increase growth opportunity. Second advantage is the risk diversification. So investor can spread their money in different countries and sectors. If one country market crash, their overall loss may be smaller. For example, suppose if a global investor hold both US stock and Indian stock, right? Suppose there is a problem in the US market. It does not hurt as much as if Indian stock are doing well. Then we have improved liquidity, which means greater liquidity. More participants from around the world means it is easier to buy and it is easier to sell the asset quickly, and prices are set more fairly. For example, India's stock market is more active and stable thanks to both local and foreign investor. That is called improved liquidity. Then we have the access to the global capital. What does it mean? So basically not just business but also government, but also individual. They can borrow or invest money from many sources worldwide. Then we have innovation and competition. So which when market connect, bank and financial company compete to offer better product, like easier payment app or newer investment opportunities. Then we have policy transmission. If a country's central bank changes interest rate or any other policy, the effect is spread across market more quickly, aligning local and global financial trend. Now the question is, what is the cost of this market interconnectedness? What is the cost? The cost, yes, let's look at the disadvantage of it. There is a risk of contagion. Means when one country has a financial crisis, the trouble can quickly spread. For example, the 2008 financial crisis started in the US and then hurt economies all over the world. Second disadvantage is the loss of policy autonomy, which means government might lose some ability to manage their own economy because decision elsewhere can heavily influence their market. Vulnerability to the external factor, which means sensitive to the outside event. So local market can become unstable if there is a bad news, political tension, or sudden changes in the global investor mood, even if nothing is wrong at home. So that is called sensitiveness to the outside event. And finally, inequality and disparity. Not everyone gain equally. Sometimes big player get richer, but a small investor or poorer country benefit less, increasing the gap between the rich and the poor. So let me give you some example to make this concept more clear. After the US increased interest rate, capital flowed out of the emerging market like India, causing their currency to drop, even if their economy were doing well. So you can see the effect. In 1997, problem in Thailand financial system quickly spread to other Asian country. This was called Asian financial crisis. So let's recapitulate the key point which we have covered in this particular slide. I told you that interconnected market help money flow to the best opportunities and let investors spread their risk. They make it easier to trade, offer more choices and promote innovation. However, crisis can spread quickly, government can lose some independence and market are more sensitive to the global event. So the advantage and the problem are not shared equally. Some people, some company, some country may benefit more than the other. These are the points. Now friends, let's see the next thing, that is the domestic and international financial interconnectedness. So friends, let's look at how financial interconnectedness work within a country, that is called domestic, and between country, that is called global and regional. We will cover both benefit as well as the risk using easy example wherever possible. First of all, we have the domestic interconnectedness. What it is all about? See, this is the foundation of the market-based economy. This forms the backbone of a market-based economy. Domestic financial market collect people saving and spread out risk, making them the backbone of the healthier economy. For example, when people put money in the bank can lend those savings to businesses. So this help grow the economy. So that is why mobilizing saving and allocating the risk. Okay. Second point, absorb external shock and improve governance. So basically a well-connected local financial system is better at handling sudden shock from outside, like a global financial crisis, and create incentive for company to follow rules and be transparent. For example, if there is a crash in the international market, India's strong interconnected bank help protect local business and consumers. Third point, stable funding for investment and greater growth. So integrated financial market make it easier for business to get a stable long-term funding which help boost economic growth and keep the system steady. For example, a company wanting to build a new factory can get long-term loan from the different part of the domestic market. The next point is reducing the economic fluctuation, that is called volatility. So when a country rely more on its own resource and less on the foreign money, it reduces the chance of sudden crisis caused by currency or timing mismatch. For example, suppose a country borrow money from its people and company, it is less likely to face trouble if the global economy changes suddenly. And then policy work better. So when financial markets are well connected locally, action by the central bank like changing interest rate is spread through the whole economy quickly and effectively. For example, when the Reserve Bank of India adjusts interest rate, all banks can respond in a sync. So changes reach business and consumer fast. Now we talk about the global and regional interconnectedness. So benefit vary by flow, quality and size. The good thing from global financial ties depends on how much money moves in, how much money moves out, where it comes from and why. For example, a stable long-term investment are generally more beneficial than quick speculative capital flow. Right. Then we have, help share risk internationally. So what is the meaning of it? See, when countries are connected, they can help each other in tough time, making consumption and economic growth smoother. For example, if one country faces a bad crop year, fund or investment from other country can help stabilize food price and supply. The next point is, encouraging a stronger economic policy and stability. So global integration encourages government to keep their economy healthy because they want to attract good capital and stay competitive. Then we have, better competition and, lower investment cost. Better competition and lower cost. So more global connection means more choice for investor and borrower, creating competition, lowering cost and making financial market more efficient. For example, if Indian company can borrow money from both local and foreign lender, interest rate might go down thanks to more competition. So friends, let's recapitulate what we have covered. We have talked about domestic interconnectedness, right? It mobilizes saving, it handles risk, it absorbs shock, they fund growth, it reduces volatility and ensure local policy work well. Then we talked about, global and digital interconnectedness. So basically we talked about it helps share risk, strengthen economic discipline, boost efficiency and lower the cost. So local bank lending to local businesses, foreign investment helping smoothing out shock in tough year and competitive borrowing cost because of both domestic and international option. So that is all about the first part of the session. So let's recapitulate just now what we have covered so far. It will be a quick recapitulation, right? Just 5 minutes to recapitulate entire points in just small points. Let's have a look. So friends, I told you that financial market involve money, security, forex, credit, insurance and pension. Economic growth, globalization, deregulation, technology, they drive market integration. Then problem in one market can quickly affect another market. This is called contagion effect. Integrated market aims from similar risk return on investment anywhere. Easy access across market segment help unify global financial market. Then in the next slide what we have discussed. So we have talked about, capital flow easily between country as they depends on each other financially. That is called capital mobility. Then technology and electronic payment make cross-border money movement faster and cheaper. Central bank now use interest rate to guide market, help align global finance. Then we talk about, connected market reduce unfair profit and improve market fairness. Then integrated market help policymakers share useful price signal. Financial integration boosts saving, financial integration boosts investment, financial integration boosts economic growth. Then we talked about, being connected help a country become a major global financial center. Connected market encourage responsible behavior and transparency. Advanced technology adoption support efficient financial services. Then in the next slide we talked about some market operate only within one country, other work internationally. Money market are generally more liquid than the capital market. Financial instruments serve different countries, right? Financial instruments serve different purposes like saving, investment, borrowing and risk management. Risk vary. So government bond tends to be safer than the corporate bond. Various participants like bank, fund, insurance company take part in these kinds of market. Then we discussed about, in the next slide, that India aim to connect different financial market to work as one system. Better market link help money flow efficiently and reduce unfair profit change. Reform encourage competition, new product, simpler rule, lower cost, higher market activity inside India. India is gradually opening up to global market in a careful way. The strong policy help market change impact the economy quickly, creating a stable and well-connected financial sector. Then in the next slide what we talked about, we discussed the domestic integration. It links financial segment inside a country. It helps diversify the risk. It aligns interest rate with the central bank policy. The same bank and the financial institution often operate across several market segments domestically. Then we talk about global integration. So global integration remove barrier to free capital flow, allow cross-border movement of people and technology. Then we talk about the regional integration. So it connects nearby country financial market around regional center, encouraged by proximity and economic size. India's participate in the regional financial cooperation like the Asian Clearing Union, right? It helps smoothen the regional transaction. Then we talk about ACU. What is ACU? So I told you ACU is a payment system among 9 Asian countries, central bank to simplify the trade payment. It settles transaction by netting of payment, reducing the need for full individual transfer. Payment can be done in national currency, saving foreign exchange reserve. ACU was created in the year 1974 to solve foreign exchange and payment problem after the global financial change. It promotes fast trade, cost saving, economic competitiveness, and member includes Bhutan, Bangladesh, India, Iran, Maldives, Myanmar, Nepal, Pakistan, and Sri Lanka. Then we discuss the key benefits. So we have discussed, that interconnected market help money flow to the best opportunity and let investors spread the risk. They make it easier to trade, offer more choices, and promote innovation. However, crisis can spread quickly, government can lose some independence, and market are more sensitive to the global event. The advantage and the problem are not shared equally. Some people, some companies, some country may benefit more than the other. Then in the next slide, we discuss the benefits. So what we have discussed is just that domestic interconnectedness mobilize saving, it handles the risk, it absorbs shock, it fund growth, it reduce volatility, and it ensure local policy work well. But the global and regional interconnectedness, they help share risk, they strengthen economic discipline, they boost efficiency, they lower the cost, but benefit may vary based on the type and based on the fall flow of the capital. Then in the next slide, what we covered the both the sides, how they are interconnectedness. So what we have discussed, in the next slide. So we have talked about close financial link means crisis can spread quickly from one country to the another. This is called contagion effort. These problems spread via direct business connection or through panic and lack of information. Too much or poorly targeted foreign money can create bubble or fail to help real growth sector. Large and sudden movement of money can make exchange rate inflation and economic unstable. Foreign bank can bring both new opportunity